Testing, testing. You will keep the exam so you can study for the final. You have the Scantron, you have all the right answers. I'm going to keep all the files for the exam up here. I may use the whiteboard today, that's why. You can still see the files for the exam right there. So what I would like for you to do is your own pace, go home, do the exam again, so that you can find your own mistakes. If I tell you how, then you won't learn not to make the same mistake again. So just go through the exam, do it at your own pace, see why you made mistakes. If you're having a lot of trouble, ask me, because if you watch the video, it's going to take you a long time to find where did I cover specifically that. So just talk to me so I can help you. Again, if I tell you right now how to do the exam, I'll do it quickly here, but you're not going to learn as much as if you try the exam again. I'm not going to ask you if you did it or not, or collect any data or points or anything. Just do it at your own pace, because you have to do this for the final. The final is comprehensive, so you're going to have to do a lot of this again. Like pivot tables, they will be in the final exam. Downloading data from Finance Yahoo, doing the histogram, you will have to do that for the final exam. So again, practice that with the exam. And then maybe in a couple of weeks, I will do a Tegrity video of me doing the exam, so you can also watch that and use it to study for the final exam. So I'm not going to do the exam with you right now. I just want to show you the histogram for the grades. That's what it looks like. So I don't have all of the numbers. I just have the picture. The class grades is not normally distributed. It doesn't have a name really. But that way, if you look at the grades you have, look at the histogram, you can see more or less where you are in the class, whether you did well or not, so that you can get ready for the next exams. Now, I did receive a few emails. Is this going to affect me a lot for my final grade? Let me open the syllabus. And as far as weights, models are 10 points each of them, so that's 50 points, 50% of your final grade. And the 3 exams, each one is 20 over 3. So what is that? 7 points, more or less, a little less than 7. So if you didn't do well in this exam, it's costing you about 7 points, which is less because, everyone got a few points at least. So it's costing you 5, 6 points, 4 points in your final grade. Okay? So really what counts more in this class is the 5 models and the final exam. That's where you have to concentrate your efforts. These exams are sort of like quizzes, so you can see where you are, if you're learning. If you didn't do well, you may have to do more practice, watch the videos more than one time. Because each one will be 20 over 3, because it's not an exact number, 6.8 or something. So each one of the 3 midterms is 6.8, 6.8, and 6.8. Yeah, but they're going to be adding up to 20. Okay? So again, it doesn't affect you too much not doing well in this exam. The second and third exam, they're going to be very similar, long, but if you practice a lot between now and the next exam, you will be able to complete the exam. Okay? And any concerns about the Scantron, anything after class, we can discuss that. General questions about the exam? Something. Okay, so we'll start a new chapter, a new topic. It is going to be bonds. And Excel has a lot of functions, so you can calculate bond prices, bond yields. You have done bonds before in your financial calculator, in your principles class. find the YTM, find the price of the bond, it's a coupon paying bond, zero coupon bonds. So let's review a bit about bonds, and then we'll start doing the calculations in Excel. And in Blackboard, I uploaded a couple files, maybe just one, but this one right here, bonds template. So we'll be using that one to build the bond model. And the third model, I know you're working with the second model, and I will try to leave some time today and also next class, so maybe if you need some help with the second one, I can help you. Is that an eraser? What is a bond in general? When you hear that, it's a financial security. And what does that mean, that it's a security? Like a mortgage loan, is that a financial security or not? To the bank? Because bond represents what? Is that there are two flavors of capital in a company. Just keep in mind that assets equals equity plus liability. And that means if a company is going to buy assets, they're going to use either equity or they're going to use liabilities. Now, equity can be common equity, preferred equity, retained earning, can be an IPO. So there are many types of equity. When you look at liabilities, companies can use commercial loan. You go to a bank, you need to expand your business, start a business, so you get a loan. And you will be making payments. Now, how do they work? Like the amortization table you're doing for that mortgage loan, you can apply the same template to a commercial loan. It's exactly the same. The payment has two components, principal, interest, maturity, and all of that. Companies can also use bonds where they sell them in the market. So both of these represent debt. Okay? Now, one of the main differences is that there's a market for bonds. So that's why they're called financial securities. You can sell them, you can trade them. They're a bond market. In fact, the bond market is much, much bigger than the equity market. Because the equity is the NYSE, NASDAQ, some smaller equity markets. But when you look at the bond market, it's many, many, many times bigger than the equity market. Mainly because governments use bonds to finance their deficits. And all governments have a lot of money in debt. So you can sell bonds in the market, you can trade them, you cannot do it with commercial loans. Another big difference between bonds and commercial loans is the payment. In a loan, the payment, as we saw in class, it has a principal component and the interest component. And I show you how to calculate both as you go on. A bond, interest payment, which is called what? Coupon. It's pure interest. So when a company sells bonds in the market and they repay that to you, each coupon payment is pure interest. There's no repayment of principal. When does repayment of principal happen in a bond? Upon maturity. Okay. If you look at the graph, and you have to do a graph like this for the second model, this is your principal, right? And this is time. So with each payment, because you apply a little bit to principal, the balance begins to slowly decrease over time. And until with the last payment, the principal will be zero. You finish paying off that loan. With bonds, the same graph looks like this. there's no repayment of principal. All the coupon payments are paying only interest. So your principal remains the same with every payment, every year of that bond. And then upon maturity, boom, they repay the principal to you. So that's another big difference between these two types of liabilities. If you took the class with me, the principles, you have seen this ones right here. You know, many years ago, this company is from 1907, so this is before computers. Company sold bonds in the market, and this is what they look like. Today, it's all in a computer. But this right here is the actual bond, and all of this right here are the coupon payments. The reason why they're called coupon payments is because you can see all of these coupons. Okay? So if you buy this bond from a company, you get this in exchange. So you're basically lending money to the company, okay? The price on the bond. So you get this in exchange for the payment. And then once, typically it's semi-annual. So every 6 months, let's say you're doing this physically, you will go back to the company and give them a coupon payment, a coupon from your bonds, and they will pay you that coupon payment. 6 months later, you go back, second coupon, and then you get your coupon payment. And you do that until you go through all of them, and there's only one coupon remaining. So that date is called maturity. So when there's only one coupon remaining here, you take that coupon along with the bond, and then the company will pay you that last coupon payment plus the par value of the bond. So that's why the graph looks like this. Because you get all of the coupon payments, there's no repayment of principal, so the principal is always the same. And along with the last coupon payment, they repay the principal to you. So now you sell back the bond back to the company for par value. Okay. If you're wondering why do I have this from 1907, a student who took the class, his grandfather passed away, so they're going through all his things, and they found a bunch of these bonds in his belongings. Here's another one. And here are the coupons, and here's the company. I'll pass them so you can see it, but you see this 100 here? That's the face value or the par value. That's what they pay to you, as principal with the last coupon payment. And when you study bonds, if you remember, that number never changes because it's right here on paper. Now, the bond price can fluctuate, and we can see that in the computer. We can simulate all of that. But the par value is always the same. It's like having a $20 bill. The face value, it's always 20. Now, the real value of a $20 bill goes up and down with inflation. But the face value is the same thing with bonds. And you can see that it's missing one as well right here, one coupon. And so what they think is somehow grandfather bought these bonds, somebody gave these bonds to him, he cashed one, and then he lost them, he forgot he had them, because he had a bunch of them. He gave me two only for class. So they found all of them. The thing is that all of these companies are gone. They're Mexican companies. So there's no place where you can go and cash these bonds or these coupons. The companies are, this is a bank, and this one is a insurance company. So they're all, they're both gone, so you can't cash. All of this right here is what we call the bond covenants, the bond contract, what it says, when the payments are due, your rights as a bondholder. Today, later, there's a website. I'll show you a current bond contract. It can be 20, 30 pages long. Lawyers get involved, so you have all of these clauses. But they used to be simpler than that. So let me pass this one. So as we discussed, you can see this one. I'll put this one here, and then they can make their way back. Okay. Now, what I want to do with you in Excel is bond valuation, and then we can simulate different circumstances and see what happens to the bond price. So when you're trying to find the value of anything, it can be a bond, it can be equity, it can be a company. We use this same basic valuation model. And what are the steps of the valuation model? One is determine the expected cash flows. So when you buy something, you're trying to find the value of something, you have to find first, so what are the cash flows that I expect from this investment? Okay? When you buy bonds, what are the expected cash flows? All of those coupon payments plus the par value. So when you do bonds, it's really simple to actually find those expected cash flows. When you buy equities, dividends. How many of them? How big the dividend? Is the dividend constant? There's no contract that says the dividend will be this number and it will be paid on this date. With bonds, you can see, in the back, there's a contract, so it's not difficult to find those. When you're trying to find the value of a company, same thing. Sales are cash flows. Cost of goods sold is another cash flow. But you're forecasting how many of them, 10 years, 5 years, are going to be growing, declining. So it's more complex. With bonds, it's easy. 2, determine the since when you do valuation, it means that you're going to be bringing to present value cash flows. To bring something to present value, a cash flow, you need a discount rate. And by appropriate, it means that it reflects how risky the investment is. So in equities, the discount rate tends to be high because it's very risky. With bonds, it's less risky, so we can use something smaller. When you're doing companies, there are guidelines that you have to follow as far as the discount rate. If you recall, when you did bonds, there's something called YTM, which means what? That is the discount rate. Okay? Now, companies with very low credit ratings, they tend to have very high YTMs. Companies with very good credit ratings, they tend to have smaller YTMs. Okay? So that's why the bonds of a good company have more value, because you're using a smaller discount rate. And then 3, find the present value of the expected cash flows. So once you have the cash flows, once you have the YTM, in this case for bonds, then you can bring everything to present value. And we already use the present value function in Excel. So for bonds, what are the cash flows? We have the coupon plus par value. Those are the cash flows. And again, they're not difficult to find. They're spelled out in the contract. The discount rate is the YTM of the bond. And the present value of all of those cash flows using the YTM, that's the bond price. You're finding the value of that one. In a timeline for a bond, it looks like this. Because bonds do mature, equities go on forever. So I will just do a dotted line and continue that timeline. But with a bond, you know how many payments in that bond. So you can go from today all the way to end. You're looking for the price today. And what are the cash flows in the timeline? Okay. It will be coupon 1, and then the second coupon, all the way to the last one. And they're all the same. A few bonds have variable coupon payment. After the bonds have this fixed coupon. And what else happened on maturity end? You have your par value. So N will be maturity. And I want you guys to visualize this on the whiteboard in the timeline, so when we do this in Excel, it makes sense. So how do you find the price, the present value? So the price, or the present value, will be equal to, I'm going to take the coupon, this one right here, over 1 plus R to the first power. I'm doing the first coupon. And I'm going to omit the sub-index because they're all the same, plus the second coupon, 1 plus R to the second power, so, plus you get to the last one, and then you also have plus the par value, 1 plus R to the same power, N. Because the coupons are all the same, this right here, what is that called when you have the same payment every period in a cash flow stream? This is a annuity, which is all the coupon payments. And then you have that par value, that's just a lump sum. So that's how you find the price of a bond. I don't want to write in this one. You can put this below that equation. The price will be equal to this. Coupon. And this right here will be the equation for the present value of an annuity, so that you don't have to do each one individually. You just apply that in the equation. Okay. So this makes more sense to you. Why am I giving you all of this again? You have seen this before. The first time you see these equations, you might get a little confused with, what is all of that? But you have done time value of money now in other classes, in this class. So this has to make more sense now that when you find the value of a bond, it's just bring into present value all of the cash flows. You have an annuity component, and then you have that par value, which is a lump sum. And then we can model that in Excel as well to find all the properties of bonds. When you did bonds in your calculators, you use the time value of money menu. So you have N, you have the IY, you have the present value, the payment, and you have the future value. And future value was always that. The par value for the 1,000. What is the par value? The bonds that you are circulating, that 100, that's the par value. And you'll find, for simplicity, in your principles classes, we always assume 1,000 here, but it can be any number, 50, 100, 1,000, 10,000. Payment is the coupon. Right? So the payment function in the calculator takes care of the annuity component. The future value takes care of the lump sum, which is the par value. And then present value was the price. IY is the YTM. And N is maturity. Okay, so you can do that. one last thing, and then we'll start doing this in Excel. Calculators can do all of that, finding present values, prices. But the value of doing that in Excel is that you can change the conditions in the bond and see what are the risks involved in investing in bonds. But from a conceptual point of view, what are some of the risks involved in buying bonds? If you buy a bond, what chances are you taking? Default is one. Company says we don't have money for those coupon payments, or we don't have enough, so we're going to cut the size of the coupon, or the company goes completely under, so you lose all your money. Others? What is that one? I don't know who said. Well, the price of the bond will, when rates go up, what happens to bond prices? They go down. And when rates go down, bond prices go up. So that's what that risk is, that if you buy a bond today and rates begin to go up, then the bond prices, the one you own, the price is going to start declining. Okay? So that's what it means. And I mean, the nice thing about a bond is you can always keep it all the way to maturity. So the bond price is going to fluctuate, but what is the bond price going to be when it matures? Par value. So you know what that final price will be. But in the meantime, bond prices are going to fluctuate. Another one, inflation. You know, if you buy a 30-year bond, you won't get your money, all of the money completely until 30 years later. So that par value, if there's a lot of inflation in the economy, you'll get 1,000, but in real value, it's going to be a lot less. There's another one that is very related to interest rate risk, and it's called, I'll put this one slash, interest rate slash reinvestment risk, which I think, well, that is what you were maybe referring to. See, you buy a bond, the rates go up. So new bonds in the economy are going to pay more than the bond that you own. So you might want to be invested in that higher coupon bond. But if you want to do that, then you have to sell the bond that you own today. You're going to take a loss because when rates go up, prices go down, so that you can reinvest at the higher rates. Because when you buy bonds, you lock in your money. You can get out by selling the bond, but you will take a loss if rates are going up. Now, this can work in your way, in your favor, when you buy a bond, rates fall, then your bond price is going to go up. Okay? And people want to buy your bond because it pays more than the bonds in the economy, so that's why you can command a premium. Now, all of these risks all of those risks will go up the longer the maturity in the bond. Default. If you buy a 90-day government bond, what is the chance that the U.S. government will default on those bonds? Today, 0. But if you buy a 30-year bond, the U.S. government has never defaulted, but in 30 years, it may happen. So the longer the maturity, the greater the default risk, just because of all the uncertainty. You don't know what's going to happen in 10, 20, 30 years. Disney, they sold, it's been several years, but they sold a 100-year bond. I'll show it to you. So it's a big company, great company, but in 100 years, who knows? Same thing with interest rate and reinvestment. If you buy a 90-day government bond and rates go up, the bond price is going to decline. But all you have to do is wait 90 days, and then you can get your par value. If you buy a 100-year bond and rates go up, your bond price is going to take a huge hit because of the longer maturity. Because if you try to sell that bond, whoever might be willing to buy the bond from you, it's also looking at all the uncertainty. If I buy the bond from you, it's a 100-year bond. So if I want to sell that, who's going to buy the bond from me? I can't wait 100 years, obviously. Nobody's going to last that long. And same thing with inflation. You buy a 90-day government bond, and there's inflation in the economy. You wait 90 days, you can sell it, and then you can spend your money before it loses too much value. If you buy a 30-year bond, and there's inflation, then that's going to have more effect in your price and your ability to buy something. So all of those risks, go up with maturity. So we can start doing calculations. We're going to calculate today for bonds prices, YTM, and we'll calculate also something called duration, which is going to tell you how risky a bond is. Kind of the one number that tells you all of that. And next class, we won't have time today. There's something else called for bonds convexity. And we can also do that calculation. So Excel has functions to do all of that. So we'll do it sort of manually so you can practice your modeling skills, and then we'll start using some of those functions. So let me open Excel. Oh, thank you. So if you can please open this bonds template file in Blackboard. And I preloaded the template with some numbers so we can do some calculations. I didn't bring my financial calculator, but if you have a business calculator, they actually have a bond menu. And when you have a bond menu, you can input dates. Because typically the way you do bonds in your regular class is they tell you 10 years. So you make n equals to 10. But when you buy a bond, you buy that bond on a specific date, and the bond is going to expire on a specific date. So you can actually input in the calculator those numbers, those dates. You can do the same thing in Excel. Now I'm going to do this one, nice round numbers, and then we can go to a website, download real numbers. So settlement. When you do calculations for bonds in Excel, in your financial calculators, the settlement is the date on which you actually buy the bond, and it becomes your property. Okay? So you settle on that day, it becomes your property. That bond now belongs to you. So it's not issue date, because issue is what? It's when the company sells the bond for the first time. But then the bond can trade hands several times. So settlement is any time that you buy that bond and it becomes your property. And then we have maturity. And because of the number dates that I used, 3/2/2015, 3/2/2035. So what is maturity for this bond? It will be 20 years. Okay. Let me show you how to do this in Excel because it'll come handy later. you can actually calculate the number of years between two dates, and you do the following: days, and if you see in your Excel, it tells you number of dates between two dates. So I'm going to open the parentheses. It is asking for what? And so that will be the 2035 year, and then you put comma. Start will be settlement. You close the parentheses, and so that's the number of days between those two dates. And then if you want to convert that into years, then what do you have to do? And it's giving you that. You can format that as just a number. So it's actually a little more than 20 years. It's 20.01 when you use. Try something. So it'll be 20.01 years. Okay. So that's something you can do in Excel. When we do options, you'll have to use that. I think there's another function. I'll try to use here. It's called fraction year. Let me see, year. Yeah. It's called year fraction. So same thing. Now this one is starting for the start date, and then you put a comma, and it's asking for the end date. And the basis is in brackets, so you can ignore that. Close the parentheses. So that's actually more accurate because it's equal exactly to 20 years. So if you want to find out how many days between two dates, use days function. If you want to find how many years, then use the year fraction. So let's replace that here. Equals year fraction, because it's actually 20 years. It's not 20.01. So start, comma, end, and then close. So I need to use 20 for now. Okay? So I replace that with year fraction. Now, let me tell you what the bases mean. I never use that function, but if I put a comma, it is asking me, and you might want to see this in your Excel, it's actual, and then actual 360, actual 365, and then European 360. So if you were doing this in Europe, you can use that European 360. And what it means is 1 year can be 365 days, or it can be 360 days. Now, years have how many days? 365. So why do we use that 360? You know, before computers and calculators, it was simpler to assume every month is going to have 30 days, including February and January. So if you multiply 30 days times 12 months, it's 360. So they did all the calculations based on every month is going to be equal. And that way it's a lot simpler when you're doing this by hand. Now with computers and calculators, because they have date functions, you know, we can use the 365, which is the default. So I'm going to just do B1 and B2 and use 365 days. But now you know why sometimes it's 360. Okay. Now, I'm going to assume I have a PY, payments per year, is a semi-annual bond. The coupon is 5%. Par value, let's use 1,000. Okay. And then you will need this function when you're doing, or this input when you're doing bonds in Excel. Redemption value as a percent of par. So we're going to assume 100. This is what it means. Sometimes, what is a callable bond? Okay, and what does that mean? If a company calls a bond, what does that mean? They buy back the bond from you before maturity. Okay, and we'll do calculations of that next class. Okay, so sometimes a company will sell you a 20-year bond, but beginning year 5, the company has the option to call the bond, and that means that you have to sell it back to the company. So the bond can be callable. When bonds are callable, companies sometimes pay a call premium. And again, we'll do examples next class, so this is more clear. So instead of you redeeming the bond for 100%, you know, let's say they pay you a 5% premium. So you will do right there at 105, and the 5 points will be the premium. But let's begin with a simple bond. So it will be just 100. This is not a it's a non-callable bond. Okay, and then YTM, 7%. That's going to be the input. Now, the way I have the bond right here, it's non-callable. It has no features, doesn't convert into anything. And this type of bond is called vanilla bond. It's a simple bond, so it's called vanilla bond. Why? What is the most plain flavor you can get in ice cream? Vanilla. So a vanilla investment will be one that it has no special features. It's just like this bond right here. And then if we do next class callable bonds, it's not vanilla because now it has that call option. So for now, we'll do a simple one. So let's find the price of the bond. And we'll do it in several ways so you can keep practicing all this function. So we're going to use the present value function first. Okay? So what is the price of this bond? Using the present value function. You need the payment, you need the future value. What is the rate equal to? Which one? The 7%, right? Don't use the 5%, that's for the coupon. You're using the 7%, the YTM. So you click on that 7%. Now, so we can be flexible. This is a semi-annual bond. So when you do semi-annual bonds, what do you have to do to the rate? You have to divide it by 2. So I'm going to do PY, or the BA divided by the PY right there. So that if you make it an annual bond, then you make the PY equal to 1. Okay? And then I put comma, and then MPER, number of periods, that will be how many? 20 times the PY. So it will be B3 times B4, comma, payment. What is the payment on this bond equal to? Okay. As the coupon, which is 5%, times the par value. The coupon payment is always coupon rate times par value. And then semi-annual means that you have to divide it by the PY, right? Comma. And then it's asking for the future value, which is the 1,000. And that will give you a bond price of 786. Now, if you don't want to see negative prices, you can put a negative in front of the present value. And so that would be the bond price. Okay. Why is the bond price less than 1,000? Yeah. So whenever the coupon rate is less than the YTM, you have a discount bond, which means less than 1,000. When the YTM is greater than when the coupon rate is greater than the YTM, it's a premium bond. So that's the way you learn to do bonds in your class. Now let's use Excel functions. So that will be the next cell. It's equal, and the function in Excel is called, and it's really simple to remember that one. You're looking for the price of a bond. The function is called price. Okay. Now, what is Excel asking you for? Settlement. So click on the settlement date. Okay. Comma. It's asking for maturity. So click on the maturity. Comma. Rate. And learn this very well because you see two of them. It's asking for rate and then it's asking for yield. So rate is the coupon rate and yield is the YTM. Okay. So I'm going to click on the 5%, comma, and then you click on the 7%. And again, in the exam models, it's really easy to flip rate and yield, comma. Then it's asking for redemption. That is this one right here, redemption value as a percent of par. So you click on that one. So that means it's a vanilla bond. So it's going to be redeemed for 100% of par value. So that means that when you bring to the company this back, they're going to pay you 100% of that number. Okay. Comma, And frequency is how often is the coupon payment. So you click on that PY, which in this case is semi-annual, so it will be 2. And the basis is 360 or 65, so we can ignore that one. So close the parentheses. So the price function gives you that number, 78.64. And that price function in Excel gives you the following: value of bond as a percent of par. So that's not the price of the bond. What will be the value of the bond in dollars? Equals 78.64. And then I'll divide that by 100 to convert that into a decimal. And then you multiply that by the par value. This is 78.64% of par value. So you can see we get the same number than using the present value function. If you look at bond tables, they always give you this number, the 78.64. They never give you the price of the bond. They only give you the 78.64. So if you have a same bond, but the par value is 100, then what is the price? 78.64. If you have a $10,000 bond, then it will be what? 7,864, etc. So that's how they display bond quotations. Yeah? So now, why is this better than doing the present value function? Because we got the same number. And that's only because I'm using nice dates. You know, it's exactly 20 years. But what if we make this, let's switch the date to, you buy the bond not in March, but you buy the bond in April. So I make this equal to 4. How many years between April 2015 and March 2035? Roughly 20 years. So if you were doing this in your principles class, you will use n equals, in this case 40, because it's 20 years times 2 payments per year. But that's not exactly the number of, you know, the right time. So the price will be how much? 786.80, not 86. Well, it's only 6 cents. But don't forget the bond market, it's trillions of dollars. So if you're off by 6 cents, 5 cents on each bond, and you have more than $1 trillion of bonds in the market on a daily basis, I mean, you know, it's going to compound and give you a huge error. Okay, so that's why it's better to use that price function. Let me switch back to 2015 just to have the same numbers for now. Okay. Now, I also want, before we do duration, modify, and convexity, YTM. You can also calculate YTM in Excel, and the function is called yield. And for this, you need the settlement. Okay, so I'm going to go and click on settlement, comma, and then you click on maturity, comma, rate, again, is the coupon. So I'm going to click on the 5%, comma. Now, that PR is this one right here. Is the value of the bond as a percent of par. Don't use the actual price. Okay? Comma, redemption is the 100. And the frequency is that 2. Pays semi-annually, and the basis is the days convention, 360, 365, close the parentheses, so you get exactly 7%, which is what we use to find the price, so we're supposed to get the same thing. Okay? That's the so risk. duration. I know some of you you're taking right now financial markets and institutions. You had an exam. You told me that you calculated duration. It was, what, a couple of weeks ago? What is duration? Let me do it on the screen. Let me open. Anybody? What is duration? How do you know if a bond is risky or not when you buy that bond? How do you know when a bond is risky or not? How do you know if it's an investment bond, if it's a junk bond? Credit ratings, okay? And which are the three main credit rating agencies? Moody's, S&P, and Fitch. And how do those agencies work? They look at the company's balance sheet, cash flows, debt, and then they give you a letter of rating, right? So if you have a triple A, what does that mean? Highest quality, meaning it's highly unlikely that the company will default. Now, we said that when you buy bonds and rates go up, what's going to happen to the bond price? It's going to decline. Or if rates go down, the bond price will go up. Okay. We also know that companies can default. So you have all of this risk involved in buying bonds. So Moody's, S&P, and Fitch, when they give those letters, those ratings, they're really telling you the likelihood of default or not. If you have a triple A, it's not likely. If you have a triple C, double C, you get into those letters, double D, then the company's already in default. But then when rates go up and down, how do you know how sensitive is the price to a change in rates? That will be duration. It's called duration. Okay. So it tells you how sensitive it is. And duration is expressed in what? What are the units? Years? Mm-hmm. So, for example, if duration equals 5 years, what does that mean for you, the bondholder? How do you use that number? How do you know, right? What does the 5 years mean? You buy a bond and I tell you duration is 5 years. What does that mean? You forgot already? What it means is if you buy a bond with a duration of 5 years and rates go up 1%, then the bond price is going to decline 5%. But if rates go down 1%, then the bond price will go up by 5%. So it tells you how sensitive your bond is to a change in interest rate. If you buy a bond with duration of 20 years, what does that mean? Rates go up 1%, your bond price is going to decline 20%. If it's only 5 years, then it will go down only 5%. So the longer the duration, the more risk you have in that bond of going up and down. That is the use of bond durations. You know how sensitive it is. Think about the market right now. Rates are at historical lows. So if rates are going to move, they're more likely to do what? They're going to go up. So if you buy a bond with duration of 20 years and they start going up, what's going to happen to your bond price? It's going to start declining very, very quickly. But if you buy a bond with a duration of only 3 years, it will go down, but not as much, 3% for every point. So that's what it means. Now, technically, when you model, duration means the following. Duration is the amount of time it takes for the bond's expected cash flows to pay for the price of the bond. Let's, for example, if coupon rate equals 5% and par value equals 1,000, and bond price equals, let's say, 990. How much is the coupon payment in this case? Equals 50. Okay. So duration means the following. You pay for the bond how much? 990. And then one coupon payment later, you have recovered how much of your investment? 50. And then with the second coupon payment, another 50. So now you recover 100. So how many years will it take you to recover your investment? It will be 990 divided by 50, right? But you do all of this in present value. So the present value of all of those coupons is always less today than in the future. So it'll take you longer than just doing the bond price divided by the coupon. But duration tells you how soon do you recover your initial investment. Okay. Let me write the screen. If you have a timeline, and we use the same example on the screen, so it's 990, and then a coupon payment of 50, and a coupon payment of 50, and coupon payment of 50, etc. Think of the timeline as a seesaw. You buy the bond, and the seesaw has here fulcrum so it can balance, up and down, like when you're playing in the playground. So if you put 990 here, what's going to happen to this timeline? You're going to tip this way, right? But then they pay you a coupon payment here, and a coupon payment here, and a coupon payment here. So what is beginning to happen to that seesaw? It's going to start leveling. There's going to be a point at which there are enough coupon payments on this side so that that fulcrum will be in the perfect place, so the line will be horizontally. So now you have the same weight, 990 on this side, then on the other side, all of those coupon payments. This fulcrum right here is the duration of the bond. And that's all done in present value. So what it means is that you have received enough coupon payments so that in present value, they're equal to what you pay for the bond. So at that point is balance, and we call that duration. It's how long it took for you to recover your initial investment. Okay? So if you buy a bond with a very long duration, that means it's going to take you a long time to recover your initial investment. If you buy one with a very short duration, 1, 2 years, it means that you recover the initial investment very quickly. So that's why it's calculating the sensitivity to a change in interest rates. So going back to the Excel, we can calculate that. Oh, you know what I didn't bring with me is the formula for duration. Let me look it up. It's right there. So we're going to do that in Excel, that equation. Now, if we go through the formula, what do you think C is in this one? Is the coupon payment, right? What is T? Time. N will be what? It is time, but is the maturity, the number of total payments. M is what? That's the par value, because it happens on maturity. R equals the YTM discount rate, and then this is the bond price. Let me go back to Excel. And even though Excel has the function, I want to show you how to do this manually, how to implement the formula. So if you scroll to the right, you're going to find that template in your Excel. And I'm going to insert 2 rows. So you can use highlight, right click, insert, couple of rows. Now, N is going to be the number of payments. We have a 20-year bond with 2 payments per year. So what is N equal to? 40. Okay, so I want to do this all the way to 40. Now, year is the actual year, so it will be 0 and then 0.5 because it's semi-annual. So your first payment right here will come when? 6 months later. Your second payment will come when? 1 year later. And then we can, if you highlight those two, Excel will keep the same pattern. Actually, you can double click. And you can see at the bottom that you have a 20-year bond with 40 payments. Now, what are the cash flows of the bond? When you receive that first payment, 6 months later, what is the payment equal to? Equals the coupon payment, right? What is the coupon payment equal to? It will be equal to the 5% and log the cells because it's going to be the same every period. So it's the 5% times, what is the par value of the bond? 1,000. I'm going to log that one as well. And then divide that one by the PY. And then log that one. So that's the equation for the cash flow. So it is 25. So you get 25. And it's going to be the same all the way to the bottom. So it's 25, 25, 25. Okay. Now, what happens on maturity? I'm going to go to the bottom. I'm going to add here what? The par value. So that will be the 1,000 right there. So that it equals 1,025. Okay. Now, I'm going to give you time to calculate this on your own. Find the present value of each one of those payments. We have done this before when we did the lease versus buy, if you remember. We had all the cash flows, and then we found the present value. So what is the present value of each one? So those are the numbers. I'm going to stop here because the class is almost over. So we'll do the calculation of duration next class. But we need to do the bond price. What if you add up all of those present values? It should be equal to what? When I hit enter for that, that's going to be equal to what? So I have all of the cash flows, and then I brought all of them, each one of them, to present value, and then I'm combining all of them, so the sum will be equal to what? Conceptually, what is that equal to? Not 1,000, but the price of the bond. So I just showed to you that the bond price is equal to the present value of each of the individual cash flows. Okay. So why am I doing this like this if Excel has a function? Because we need to do that for the duration next class.